Okay, Rob.
Great. Hello and welcome to today's Unequal webinar, Preparing for the Business Impact of COVID-19. My name is Rob Dietel. I'm Director of Executive Programs at MIT Sloan, and I'm delighted to be your moderator today. Just to note, this is the first in a series of 3 webinars that we'll be holding over the next few weeks that deal with very timely and relevant topics related to the COVID-19 pandemic. So just a note to mark your calendars for June 3rd for our next webinar, Emerging from the Crisis, Talent Development in the New Normal, followed by our 3rd webinar in the series, Voice of the Customer during COVID-19 on June 10th. Details and registrations for both of those upcoming webinars are available on the Unicon website. Fair to say that in the past few months, we've all been in a very reactive mode responding to the COVID-19 crisis. Today, we'll be exploring a longer-term perspective on what COVID-19 might mean to us in the months and years ahead. Before we get started, I do have a few housekeeping items. Just to remind you that today's webinar will be recorded. You'll receive an email with a link to the recording, so if you have colleagues that aren't able to attend or you want to revisit the website or the webinar, you'll be able to do so. Slides will also be available via a download link on the navigation panel that you should be seeing. And the slides will also be available with the link that we send out to the recording. We will be holding a Q&A period at the end of the webinar. You're able to submit your questions via the question box, and we'll relay those to our guest today. And then lastly, as a reminder that today's webinar is in compliance with the Unicon antitrust policies. We ask that you be mindful and respectful of the policy. We won't have any discussions around specific pricing, and we promote free and fair competition. With those housekeeping items out of the way, I'm delighted to introduce you to our keynote today, our keynote speaker delivering the presentation, Professor Mauro Guillén. He's the Zanman Professor of International Management at the Wharton School, author of many books and articles, including some very relevant and timely books, The AIDS Disaster, The Last Pandemic, The Architecture of Collapse, and 2020, How Today's Biggest Trends Will Collide and Reshape the Future of Everything. As the title suggests, we're in for a very timely and informative webinar today. Without any further delay, I'm pleased to introduce Professor Mauro Guillén. Mauro, over to you.
Thank you so much, Rob, for that wonderful introduction, and welcome to all of you. Thank you for tuning in. I hope that both my audio, my video, and the slides are perfectly visible. If not, I'm sure that Rob will let me know. And I thought that given the kinds of challenges that I think executive education will experience in the next few months and years, I thought about essentially dividing my presentation into 2 segments, okay? In the first segment, I'll try to give you some good news, okay? I think we're all in need of good news, economic news, that is, in the sense that executive education, as I see it, is a very pro-cyclical activity. That is to say, when the economy is going relatively well, then we always see a spike in demand for our services, for our courses, for our programs. And then after that, I would like to tell you more over the long run what I think are the most important transformations that businesses here in the United States and abroad are going to go through. I'd like to give you some data, preliminary data that we have on that. And I'd like to essentially make the argument that I think content in executive education programs will need to change in the future to accommodate, to help those kinds of business transformations that I think are going to be taking place as a result of this pandemic. So first to the economic news. So here you have, let me start with the United States, by the way, and then I will travel, so to speak, to other parts of the world. When we think about gross domestic product, GDP, as you know, the second quarter is likely to be brutal. If you take a look at the first line on this table, minus 44.5% evolution of GDP here in the United States. This is the estimate from the Conference Board, which, at least from my perspective, is probably the best economic forecasting service that we have here in the United States. But notice that the good news is that they are anticipating, they are forecasting a pretty strong recovery in the economy during the third quarter and the fourth quarter of this year to finish with a minus 7.2% annual, okay? Now, for other parts of the world, the situation is in some cases slightly better or slightly worse, depending on how you look at it. So within the advanced economies, meaning essentially Japan, Europe, and the United States and Canada, I think we're going to see a deeper and longer crisis in Europe than here in the United States for a variety of reasons, and I would be very happy to get into those during the Q&A segment. And we're going to see the same thing in emerging markets and developing economies. We're going to see some of them like China and India that are going to keep on growing this year. As you can see on this table for 2020, the projection by the International Monetary Fund, the IMF, is 1.2, 1.9% respectively for those two large Asian economies. But then many others, especially if they are exporters of commodities, if they are exporters of energy, such as oil and gas, they will suffer much more during this year due to reduced economic activity in the largest, most advanced economies in the world. So, in other words, we're going to see that there will be economies going at two speeds during this year, both in the developed parts of the world and in emerging markets and developing economies. Now, the big questions, as you know, is what's going to be the shape of the economic recovery here in the United States. Again, I'm using the forecasts of the conference board here. And by now, this is already the end of May, I think we have abandoned the idea that we had, or the hope, that we would experience, at least here in the United States, a V-shaped recovery. That would be the orange line over there. We're most likely on a U-shaped recovery, which is the gray line that you see on the chart. And I think we can avoid a W recovery, which in this case could be triggered by a second wave of infections. And we can also talk more about that during the Q&A section. Now, I would like to also bring to your attention that there's no agreement actually as to what the future evolution of GDP is going to be over the next few weeks and months. I just presented to you the forecasts from the conference board, but quite frankly, depending on whom you ask, depending on which investment bank or which economic consultancy or forecasting service you believe in, then you get a very different number. And this is what you see on this chart. For example, for the Euro area, you see a most optimistic forecast of about 0%, so essentially no change in the level of economic activity. But then the most pessimistic forecast is a minus 9%. So in other words, I would take with a grain of salt all of these forecasts about how the economy is going to be doing during the rest of this year. And instead of using forecasts about GDP growth, what I would like to persuade you about in the first part of this presentation, in the next 5 minutes or so, is that there are two other indicators that I think are forward-looking and will be, I think, much better in terms of anticipating the shape, the speed of the recovery. So the first one has to do with consumer confidence. As you know, surveys are routinely conducted in many countries around the world, asking consumers about their attitudes towards the future, about how confident they feel in terms of spending money. And here is where we see the first pieces of good news. So as you can see on this chart, which compares the US and China, which are the two largest economies in the world, and as I understand it, also the two largest executive education markets in the world, along with Europe, what we see is, yes, a decline in consumer confidence since the month of February, but the last reading for this survey in both the US and China indicates a rebound in consumer confidence. You can appreciate that towards the right-hand side of the chart. Another thing that I want to bring to your attention, which I think is very important, is that even the lowest point during this crisis was not as low as the one that we went through 12 years ago during the global financial crisis of 2008, 2009. And there are perhaps two reasons for this. One is that governments have acted more swiftly, and so have central banks. this time around. And the second, which I think is extremely important, is that this time around, when it comes to consumer confidence, we had technology, and people could secure from their homes all of those necessary or essential goods and services that they needed during the lockdown. Let me now go to the European Union and Japan, the other two big advanced or rich markets in the world. And once again, we see some, light at the end of the tunnel, especially for the European Union. We see a rebound in this indicator. It's a small rebound, but it's a rebound nonetheless over the last few weeks. And also notice, by the way, that in the European Union, which is a very important market, we see that the depth of the decline in consumer confidence this time around is much, or has been much less than during the 2008-2009 financial crisis, and also the double dip, the second recession that happened in Europe, if you remember, in the year 2013-2014, driven by the sovereign debt crisis, especially in the southern part of the continent. So that's the comparison between the European Union and Japan. Now I have here Germany and France, the two largest economies in the Eurozone. We still don't have a reading from last week regarding consumer confidence, but I believe that when we get that new survey in, the data, in about a week, there will be a rebound in Germany and in France. And lastly, here I have in Europe, Spain and Italy, the two economies, the two countries that, as you know, have been the worst affected by this crisis so far. And once again, no rebound yet, but the depth of the decline is not as bad as what it was in 2013, 2014. Remember, during in the midst of the sovereign bond crisis in those two economies. Finally, Brazil and Mexico, the two largest economies in Latin America, a decline in Mexico in consumer confidence. And I'm not going to try to explain Brazil to you. I travel to Brazil a couple of times a year frequently to do executive education over there. It's a place that sometimes defy all comprehension. It is perhaps too early to see a decline in Brazil because, as you know, the pandemic has only hit the country in a big way over the last couple of weeks. So we may need to wait another week or so to get a more accurate reading about consumer confidence. Now, the second indicator that I would like to share with you that I think is much better than GDP growth estimates or forecasts is the so-called manufacturing PMI. PMI stands for Purchasing Managers Index. So this is like the Consumer Confidence Index. It's an indicator of the confidence of how bright or how gloomy manufacturing managers see the future, the near future. So once again, for the US and China, very sharp declines as a result of this crisis over the last few weeks. But in China, as you can see, a very dramatic bounce up from the lows of the month of March, and which is extremely good news because here we're talking about manufacturing, and of course China is the world's largest manufacturing hub. If we go to Europe and Japan, European Union and Japan, again we see very good news coming out of Europe. The last reading in terms of the manufacturing PMI was indicating a very strong rebound. That's excellent news. And that has also been recorded in the two largest economies in Europe, Germany and France, as you can see on the chart, with very sharp rebounds over the last couple of weeks as well. So all of this very good news. Spain and Italy, we still don't see the rebound in terms of the manufacturing PMI, but it is, I think, just a matter of time. Those two economies are reopening. Since 3 weeks ago, workers are back at the factories. So we should see a rebound in this indicator in the next week or so. And then finally, Brazil and Mexico, the two largest economies in Latin America, and still no rebound over there. Okay. So once again, what I've been trying to convey to you during this first few minutes is that things are looking better in terms of the evolution of the real economy. That's good news, I think, for educational institutions in general. It is particularly, I think, very good news for executive education. I have also made the argument to you that instead of looking at GDP forecasts, I personally find it more useful to follow indicators about expectations, about confidence, especially among consumers and among managers at manufacturing companies, in particular purchasing managers. So let me add a note here about something that worries me in the global economy right now, which is what's going on with certain emerging markets. Some emerging markets have become very, very important to the educational sector in the US and in Europe. And as a result, I think following trends there is extremely important. And there's something that we haven't talked about, which is what's going on with the financial flows in the world as a result of this crisis. And there's one thing that up until about 3 weeks from today was worrying me, which is that we were detecting very high volumes of capital, of portfolio capital, short-term capital, flowing out of emerging markets, which is what you see here on the chart. So the horizontal scale measures weeks since the outflows began. And as you can see, during the first 10 weeks or so of this process, very large amounts of money were flowing out of emerging markets during this pandemic. Those volumes were much, much bigger than the ones that took place during the 2008 financial crisis or during the 2013 mini, crisis that we had when central banks in the world started to withdraw their monetary interventions, and also during the 2015 slowdown in China, which, if you remember, had very direct implications for all of those emerging economies that were exporting commodities and energy to China. So up until 3 weeks ago or so, this was a chart. This information was essentially preventing me from sleeping well at night. However, things have improved. Things have improved dramatically during the month of April. So this is the same kind of data as before, but now we have the breakdown for different parts of the world. And I would like you to focus your entire attention on just the 2 bars towards the right of the chart. The last bar is for the month of April of 2020, and the second to last bar is for the month of March. So once again, in the month of March, we see these dramatic, outflows, right, of portfolio capital, of short-term capital flowing out of emerging markets. But as you can see, during April, the volume of those outflows has shrunk dramatically, especially insofar as China, the rest of emerging Asia, and also Africa, the Middle East, and emerging Europe are concerned. We still have, as you can see, very large volumes during the month of April of outflows from Latin America, comparable to the volumes that we had in March. So right now, I'm only worried about Latin America, not about all emerging markets. And let me explain why I was worried about this. You see, this crisis began because of a public health emergency. We shut down the economy. That essentially sent unemployment up, and the level of economic activity came down dramatically. But so far, in most countries around the world, we have avoided a financial crisis associated with the downturn in the real economy. But you see, emerging markets are particularly vulnerable to a financial crisis if they experience large outflows of short-term capital, because those kinds of volumes that you see here on the chart could eventually force a devaluation crisis. The currency could lose value, and it could also cause the financial system or the banking system to have a lot of problems, and that to in turn create even more issues in the real economy. So it's very important to avoid that. And as you can imagine, from the point of view of the kind of work that we do in executive education, if some emerging markets were to experience a sudden devaluation of their currency because of these large outflows of portfolio money, that would limit the amount of money that they could be spending either in dollars or in euros to send their executives to programs here in the United States or in Europe. So let me now rotate to the second part of my presentation. So the first part was meant to give you some hopefully good news based once again on those two indicators, consumer confidence and the manufacturing PMI, with the very important footnote about this concern that I have about outflows of capital and potential currency devaluations in emerging markets. The second part has to do with preparing for the recovery, but more specifically with the ways in which I think businesses will need to adapt to the new situation. And I am going to emphasize to you 4 different areas, topics that I think companies will be, very keen on learning more as to what is it that they must do in order to adapt successfully to whatever it is, the new reality in the global economy after this pandemic. But first of all, I think that companies have learned this time around that it is true what generals say when they go to war, that once the war starts, plans are worthless, but planning is everything. I think there's going to be a lot of emphasis at companies in the months to come, in the years to come, in terms of thinking about the process of planning for big disruptive events, such as the one that we're going through. And I believe that many businesses, both large and small, have been caught by surprise this time around. And they had to scramble in real time to put in systems to cope with the specific aspects or challenges to this pandemic, including the 4 that I'm mentioning here. And I would like to tell you a little bit more about those in the next 10 minutes or so before we go into Q&A. So the 4 topics that I think have caught a lot of businesses by surprise, and they will want to rethink the way in which they operate, are the following: supply chain management, automation, remote work, and how do you engage customers, especially when you need to shut down. Well, let me begin with supply chains and showing you some data from a survey that was conducted about 10 days ago, and you have the reference to it at the bottom. What most managers who handle the supply chains for companies here in the United States have reported is that during the last 3 months, they've experienced declining volumes. They've also experienced transit delays from the port to the customer, a lack of capacity, that's for the industries or for the product and service categories that have seen their demand go through the roof as a result of this pandemic. And as you can see at the bottom in the pie chart, nearly half of them, 42%, say that in the future, they are going to rethink the way in which they obtain the products or the goods, the services, the components, the parts that they need. In other words, that they're going to restructure their supply chains. And an additional 28.9%, as you can see, say that maybe they will do so. So what's needed according to them? Well, they say that they will need to, in order to restructure those supply chains, to make them more resilient to disruptions such as the one that we're going through. They will need to invest in assets. They will need to retrain employees. Perhaps they will need to make acquisitions. But as you can see, 2/3 of them, 67%, responded that they anticipate investments in technology. So I believe that as a result of this crisis, companies are going to rethink their supply chain in a number of ways, right? As you can see over here, we can actually ask, CFOs, not the supply managers themselves, but rather the people who at companies worry about the bottom line, the chief financial officers, in search for answers as to what do they believe will need to change. And they say, number 1 priority, develop additional alternate sourcing options. Number two, understand the financial and operational health of suppliers. Maybe change contractual terms, extend the visibility into suppliers' networks, and so on and so forth. You can read the rest on the screen. So essentially, what I'm trying to tell you is the following. This is what I will predict will happen. And I think there's going to be a great demand on the part of companies for programs that help them understand these dynamics. The first shift that we're going to see is, you see, for a long time, 30 or 40 years, companies have been building their supply chains based on the principle of just-in-time production, meaning they would only obtain the inputs, the parts, the components, the products necessary in the last minutes whenever they felt they were needed, either in the factory or in the marketplace. And I strongly believe that this principle will be abandoned, at least in part, in the next few years. And we're going to move towards more just-in-case, that's my own term, just-in-case supply chains, with way more redundancies and buffers. I think companies will want to strike a very different balance between efficiency and reliability. So yes, making supply chains more resilient to disruptions is going to come at a cost. It's going to reduce the efficiency of the chain. But I think consumers ultimately will be willing to pay that price in exchange for more security, more resilience, more reliability. I think value chains will become more diversified in the future, and there will be an enormous investment in technology to make the supply chains more resilient, as we saw in the survey that I showed you earlier, indicating that the most important area of investment in order to restructure supply chains will have to do with technology. So big changes here. And by the way, these are changes that have not only to do with the supply chain, they have to do with the entire strategy of the firm. So I can see a lot of demand on the part of companies that will be asking questions about how do we change the supply chain? How is that going to change other parts of the organization? What kind of training do we need to do for employees? What type of technologies are there that are going to help us become more efficient? And it goes without saying that the Chinese economy is going to suffer as a result. You see, in 2019, China produced nearly 50% of all of the high-tech goods in the world, about 42% of chemical products in the world. You can go down the list on this chart. Well, even before the pandemic started, there was already a movement by American companies, by European companies, away from China-based sourcing. That was triggered by two events. First was a long time ago, so to speak, in 2011, the Japanese earthquake and tsunami that essentially disrupted global supply chains. And remember, it was something that affected only one part of the world. So that event clearly indicated to companies that they needed to make the supply chains a little bit more resilient and diversified. But more importantly, what really triggered the pre-COVID-19 wave of restructuring of supply chains was a trade war between the United States and China. During 2019, scores of companies around the world decided to diversify away from China. And guess which were the sourcing locations that benefited? Number one, Taiwan. Number two, Vietnam. Number three, Mexico. Number four, Eastern Europe. So this process of restructuring supply chains was already going on before COVID-19, but the pandemic has accelerated many times over that process. Now, the second thing that I wanted to bring to your attention, the automation has been going on in the economy for the last 50 years, and especially over the last 20 years or so. But I believe that this pandemic creates new incentives for companies to automate. And this is not just in the manufacturing sector, it's also in the service sector. The reason is that during this crisis, during the lockdowns, companies were forced to send their workers home. So they had to slow down their operations, in some cases, to shut down completely. But you see, you don't need to send the robots home if we have another public health emergency. So I believe that automation incentives will be much stronger as a result of this crisis, as companies seek to make their operations more resilient. Now, I want to say something really important here, which is that there's going to be one consequence. Many of the jobs that people have lost during this recession perhaps will not be there after the recession is over. Once again, because there will be automation, especially, I think, in the service sector. Let me show you data for one particular part of business operations, which is warehousing. So warehouse automation is something that has been going on. We've all seen those photographs of Amazon warehouses being automated. Well, let's ask the managers who are in charge of warehouses. And the data that you see on the screen are for the United States. The blue bar, vertical bar that you see, were the projections, the forecasts as to spending in millions of dollars on warehouse automation. And those forecasts in the darker blue were made before the pandemic hit. And then the gray bars is the same forecast, but revised after the pandemic. As you can see in the year 2020, the consensus is that there will be less spending on warehouse automation. Well, in part because the economy is in recession and we still need to wait for the recovery. But in 2021, 22, and 23, the revised forecast for investment by companies in the United States in warehouse automation is, about 15, 20% higher, depending on the year, than the previous forecast. So there will be, no doubt, more automation. That means redesigning the workflow, redesigning work processes. That means retraining workers. That means redefining job descriptions. That means a lot of internal reorganization at companies, both in manufacturing and in the service sector. And therefore, I would anticipate a lot of need for knowledge, for new concepts, new ideas, new ways of reorganizing businesses in the wake of this pandemic. Topic number 3. We're all familiar with this one, remote work. All of us here on this call are practicing right now. And first of all, I would like to bring to your attention 2 numbers. And I have those 2 numbers for the US. They're very similar in Europe, with one exception that I will mention in a moment. First of all, prior to the beginning of this pandemic, let's say at the end of 2019, about 37% of all American jobs could be performed remotely, okay, about 1/3. But here in the United States, prior to this pandemic, only 3% of workers were performing their duties remotely most of the time. So the first percentage, 37%, is quite similar in Europe or in Japan. The second percentage is very different in some parts of Europe, especially Northern Europe and Scandinavia, where prior to this pandemic, between 18 and 23% of all workers were performing their duties, at least in part, remotely from their homes. So here's my forecast. My forecast is that, well, that 3% is going to be much higher. It already is much higher, right? Because we have all of us working from home. But my second forecast is that the 37% that you see up there, which is the upper limit, this is the number of jobs that could be remote. That percentage over the next few years is also going to grow. It's going to be 40%, it's going to be 45%, it's going to be 50%. How is that going to happen? Well, it's going to happen because companies are going to redesign their work processes in such a way that they can have more people working remotely. So in other words, we have already seen an increase from the 3% to maybe 20, 30, 35%. Most of the people who can work from home are now working from home while we are at least in partial lockdown. But again, my argument is that over the medium run, we're going to see the upper bound, the 37%, also increase. Okay. Now, if you look down to the second bullet point that I have on this slide, I think we're also going to see a shift away from just working from home when it comes to remote work towards more work from the so-called co-working spaces. So in other words, that people will prefer perhaps to not go to the office, but also not to work from home for the reasons that I'm going to tell you about in a moment, but rather that they would like to go to some satellite co-working space that is very close to their home, but it's not the office, right? Now, let's ask the CFOs. I like asking questions of the chief financial officers because they have the money and they know what the impact of all of these things is on margins and financial performance and the bottom line. So in this survey that was conducted by PwC about 2 weeks ago or so, the question is, which of the following is your company planning to implement once you start the transition back to on-site work? Well, 49%, half of them, make remote work a permanent option for the roles that allow it. Number 2, accelerate automation and new ways of working, 40%. And number 3 is reduce the real estate footprint. Of course, they want to save money on office space. So here we see exactly what I was telling you about, which is number 1, companies are going to try to redesign the jobs, redesign their processes, reinvent their organizations. They will need a lot of help in doing this. I think in executive education, we can probably offer them very good insights as to how that can be accomplished. And as you can see, they will want to make remote work a permanent option for the roles that allow it. But at the same time, they want to increase the number or the proportion of roles, of positions, of jobs that can be performed remotely. Now, another very important issue that I don't want to leave without a reference to it, which is unequal access to remote work. So we need to be very careful here because, at least based on this survey conducted by the Pew Research Center here in the United States, what they found was that there are tremendous inequalities in terms of access to remote work. So women have more access to remote work than men. In a moment, you will understand why. The reason is education. As you can see at the bottom on the left-hand side, 62% of the jobs that college graduates have can be performed remotely, but only 9% of the jobs of people without a high school diploma can be performed remotely. That's because, of course, these are manual occupations, and most of the time they need to go to the place, to the location of the company in order to perform their duties. There are also tremendous differences here in the United States by race or ethnicity. Look at the differences between whites and Asian Americans on the one hand, and African Americans and Hispanic on the other, in terms of what percentage of those workers could possibly perform their duties from home. And then on the right-hand side, you have another bit of information which I think is very relevant, which is that it is precisely the highest or the higher wage earners, the ones who are working increasingly from a location other than the office, right? So this is what I think is gonna happen. I think we're gonna see a shift by companies and by people, especially by workers, in terms of, what are the remote-friendly industries? What are the remote-friendly occupations? Also, I think we're gonna have a new ranking of remote-friendly companies, right? Companies that enable workers to work remotely. And finally, remote-friendly jobs. Now, just look at those categories. The effects in terms of organization, leadership, training, work processes, and so on and so forth are going to be enormous. And companies are only beginning to do this. During the last 2 months, they've been forced to do it. Now they're thinking about ways in which maybe they want to make this permanent. Not only that, maybe they want to expand the universe of jobs that can be performed remotely. Now, by the way, what is, from the point of view of employees, the benefits of remote work? Well, according to this survey that was just conducted here in the United States, well, the ability to have a flexible schedule, the ability to work from anywhere, not having to commute, ability to spend time with family. But from the point of view of leadership, organizational behavior, all of those kinds of programs, human resource, talent management, and so on and so forth that we offer, look at what people are saying in the midst of this pandemic about the downsides, about the cons of remote work. Well, what is your biggest struggle with working remotely? Collaboration and communication, loneliness, not being able to unplug, distractions at home, being in a different time zone than teammates, staying motivated, taking vacation time, okay? Perhaps separating work and life, being able to, not dedicate too much time to work. And happily, I think that we have experience in all of this. It's called virtual teams. You see, multinational firms have been using virtual teams for the last 50 years. This is not a new phenomenon. They've been doing this to tap into talent across geographies, to avoid duplications and overlaps, to minimize travel costs, to exploit time zone differences. And what we know from research and from the executive education programs that exist in this area is that there are two requirements for virtual teams to work properly. The first is that you need to generate a shared identity, and you need to generate shared understanding among the team members. So this is a long way of saying that there's going to be great demand for anything that has to do with how companies transform themselves. How do organizations reinvent themselves in this new brave world in which there's going to be more remote work than in the past? And then finally, engaging customers. Just 1 minute on this. I've been, emphasizing in my webinars to companies recently that even when you're shut down, you need to continue engaging customers and you need to plan for pent-up demand. As you know, during the first stages in this crisis, during the lockdown, certain product categories, the ones that you see at the bottom of this table, saw an increase in demand: packaged food, fresh food, home care, toys and games, retail tissue, and hygiene. But now, what we're seeing is that companies are starting to pivot towards serving pent-up demand in luxury goods, personal accessories, apparel and footwear, eyewear, beauty and personal care, consumer electronics, the categories that you see at the top of the table. So I think from the point of view of marketing, from the point of view of allocating resources to deal with changes in demand in the marketplace, there's going to be huge interest on the part of companies to come up with new models, new techniques for managing this process whenever there is a big disruption in the market. Finally, I want to just bring to your attention one last thing so that we leave enough time for Q&A, which is the role of corporate social responsibility. There was a survey conducted by the Elman Trust about 3 weeks ago that clearly demonstrated that consumers coming out of this recession, of this pandemic, were going to be brand loyal to the extent that they recognized that their brands, their companies, had done enough to help not just them, but society as a whole get out of this problem. As you can see, very high percentages of consumers across markets, both developed and emerging, that we're asking companies to continue doing corporate social responsibility and social impact. But you see, during a crisis, that's one of the first categories of spending that companies tend to cut. So I think there's going to be renewed interest also out there for how companies should rethink their corporate social responsibility programs in the wake of this pandemic. So let me stop there. I've given you the macro picture, hopefully, conveying good news to you. And then I have brought to your attention, I think, 4 areas where I am anticipating there will be very big demand from the part of companies, for help, for advice, for retraining, for new perspectives, for new models. And those were supply chains, remote work, automation, and finally, consumer or customer engagement. So thank you so much. And Rob, I hope that there's questions in the Q&A that I can begin to answer.
Yes, Mauro, thank you for a wonderful presentation. Some really good insight and information that I think we can all use and benefit from. At this time, we are open for question and answers. If you'd like to input or type in your question via the question panel on your navigation panel, we'll be able to relay that tomorrow. While we're waiting for some initial questions, I did have a couple that popped to mind. Among the 4 areas of opportunity that you mentioned, Mauro, do you have any sense or do you have any advice for executive education professionals on how they might want to prioritize? Is there any 1 or 2 areas that are going to need more imminent attention, or is it kind of an all-the-above scenario?
Well, I believe that all of them are very urgent. You see, I chose those 4 precisely because not only I believe, given my contact with companies over the last few weeks, that they are moving in that direction, but also because they had already been moving in that direction prior to this crisis. The crisis is just a huge acceleration in terms of remote work, in terms of automation, in terms of the reconfiguration of supply chains, which, remember, really started big time with the trade war between the US and China over the last couple of years. And then finally, of course, customer engagement. So I would say all 4 are urgent, and that's why I decided to focus my presentation on those 4. There are many others that we could also focus on. But I also want to highlight one thing that is very important, which is that companies, in order to successfully transform themselves within each of those 4 topical areas, they will need to pay attention to what are the organizational implications, the leadership implications, the talent management implications, the financial implications, the marketing implications, the operational implications. So across all of the functional areas, right, of the firm, there will be a great need for change, for new models, for new ideas, for new templates. And that's where I think executive education comes in.
Great, thank you. We are receiving several questions coming in. Thank you for submitting your questions. One is, what advice do you have for companies when it comes to investing in, even though they may be experiencing financial challenges, in reskilling or upskilling their workforce?
Yes, absolutely. That's a great question. And the answer to that question depends on another consideration that companies are going through now, which is, how do we redesign our entire organization so that we can ensure business continuity in case there is another big disruption such as this? And that kind of process of reconsidering, redefining, restructuring, the entire workflow of the firm will include, in some cases, upskilling employees or hiring different kinds of employees. In some cases, it will mean investing in automation. So once again, I think the division of labor between humans and machines at most companies, especially, by the way, in the service sector, I think will be a huge topic in the next few years. And I think there will be enormous demand on the part of companies for ideas and for clues as to how to go about doing that. But let me add another issue, which I think is very important. I think people, I think workers, I think new graduates from universities and colleges will also be making decisions about which are the jobs that they would like to have post COVID-19. And as I mentioned earlier, I'm going to put that slide back on the screen. I think there's going to be a movement towards remote-friendly industry, remote-friendly occupations, and so on and so forth. In other words, preferences are shifting also on the part of workers. So it's not just companies. And I believe that companies that reinvent themselves in ways that, are more congruent with these trends will essentially be more competitive when it comes to attracting the talent that they need. So I think it's going to work both ways in terms of both companies and employees or potential employees making decisions based on different preferences and different incentives in the near future.
Thank you. Another question from the audience on the topic of globalization versus protectionism. How do you see these opposing forces coming out of the pandemic? Will one be strengthened, or will there be a shifting in globalization versus protectionism?
Yes, so I have spent quite a bit of time doing research, and also I teach about globalization, and in particular how companies pursue foreign markets and foreign opportunities for doing business. And I think we are at the beginning of a relatively different phase, which is, I would call it re-globalization, RE-globalization. Why do I say that? Well, let me give you two examples. The first one I already mentioned, which is that in response to the trade war between China and the United States, companies didn't abandon globalization. They didn't do onshoring. They didn't bring back the sourcing to the United States. What they did was they shifted from China, as I mentioned earlier, to Taiwan, to Vietnam, to Mexico, to Eastern Europe. So I think there will be a recalibration of the global activities of companies, but I don't think they will want to become domestic companies, for example, when it comes to their sourcing. Now, having said that, the second point that I want to make is that, yes, there's always going to be this temptation on the part of governments to protect. Hey, things are not going well. Let's reserve our consumer market for our companies, right? And there's a lot of tensions going on out there, frictions in this respect. I think we have to resist that temptation. We have to resist it at all costs for the following reason, which is go back 100 years ago to the Great Depression. What made the Great Depression much longer and much deeper was protectionism. Every country back in the 1930s decided to protect, to raise tariffs, to create other obstacles to trade. And that made the recession and the recovery so much tougher. So I hope that we will change this time around, and we will see that protectionism is not the solution. And you see, at the end of the day, protectionism, and this is also something that I personally teach all the time in executive education, protectionism is a recipe for lower standards of living over the long run. There's no question about that. Now, having said that, with automation and also with free trade, we need to make sure that we don't leave too many people, too many communities behind. We need to take care of those who are displaced by automation and by free trade. But I don't think the solution is to destroy the machines or to protect, because that over the long run will result in lower standards of living.
Thank you. Another question, do you have any insights about the difference in supporting the unemployed in the US and in the EU? If there will be jobs lost as the economy adjusts, will the US perform better?
Yes, so this is a very important question. And you see, the problem with every policy, the problem with every decision that gets made either by the government or by companies, is that you normally have trade-offs, okay? So no solution is perfect. There's always a trade-off, right? So when it comes to protecting workers during this downturn, there are two basic solutions, right? So one solution is to say, okay, let's have companies lay off their workers. And what we will do is we will pour more money into unemployment insurance so that workers have more income, so that doesn't hurt the economy in terms of consumption. And also that those unemployment benefits last longer, so that there's time for those workers once the economy recovers to try to find a job. That's one way of thinking about it, right? The other way of thinking about it, which Germany, for example, has been pioneering during each of these downturns, including the one 12 years ago in the wake of the financial crisis, is to say, no, we don't want people to lose their jobs. It's better to keep people linked to their companies. So what we're going to do is subsidize the companies. We're going to give the companies money so that they can continue paying their workers during the crisis, because it's better not to go through the disruption of unemployment, because their thinking is once the economy recovers, it's much better that the workers are still working for the company. So instead of just working a few hours, they just go back to working full time. And once again, they've been paid their wages through government subsidies throughout the crisis. Well, here's the problem. The problem with this second approach is that perhaps you're interfering with the market mechanism in the sense of, hey, maybe as a result of this crisis, some companies need to scale down. Maybe they need to be smaller. Maybe they need to be acquired by other companies. Maybe they need to go bankrupt. And that's how the market economy works. It's what, if you remember the famous economist Joseph Schumpeter called creative distraction, right? So again, each of the two approaches has advantages and disadvantages. It's still too early, of course, to know which one will work better. Here in the United States, we normally prefer not to interfere with the market mechanism. In many economies in Europe, and I think Germany is one of them, they prefer not to disrupt things too much. It remains to be seen. I think, you know, as always, the answer to the question will be that each of these two ways of addressing the problem of unemployment or potential unemployment will be better for certain kinds of industries than for others. So it's going to work much better in certain parts of the economy than in others. But it's still too early to, you know, provide a full answer to the question. But yes, in response to your question, we are seeing very different approaches, and there are very important trade-offs involved.
Great. And the next question relates to the remote working projections that you have. Now that everyone's working from home and likely to continue doing so, what kind of skills might be in demand going forward?
Well, I think we will need not just new skills, we will need also, you know, as employees working from home, new mindsets, right? So as I told you, there's the possibility of burnout, there's the possibility of not being able to disconnect. There's the issue of productivity. Are we equally productive when we work from home? Also, I think the more important question, which is, we don't have to either be working from home or working at the office. There's also hybrid approaches, meaning, okay, we work a couple of days a week or 3 days a week from home, and the other 2 days we go to the office to ensure that there's coordination and so on and so forth. So I think we're only at the beginning of understanding how we can have a situation in which 30, 40% of the workforce perform their duties remotely. We have done that over the last 2 months on an emergency basis. But one thing is to do this for 2 months, and quite another is to redesign the entire company so that we permanently do this well into the future. And I think that will, as I mentioned earlier, require a lot of understanding, deeper understanding of organizational behavior, of psychology, also of workflow redesign, and so on and so forth. So those transformations will require quite a bit of redesign, rethinking on the part of companies.
Thank you. And the next question relates to leadership styles. The three top countries, the US, Russia, and Brazil, I'm assuming top countries in terms of being problematic with COVID-19, the three top countries are led by autocrats. What does this say about our teaching leadership?
Yes, this is an interesting question. By training, I'm both a political economist and a sociologist. So I have done, actually, believe it or not, some research on what's going on right now with democracies and with this new category of rulers that we have in the world, which I will call strongmen, right? Like Russia, Turkey, and several other countries come to mind, and Brazil, of course. So I think, leadership in general, there will be a revolution in terms of how we think about leadership, how we think about leadership in the world in terms of these trade-offs that we have in the political realm, right? With so many people that feel displaced, that feel forgotten, that feel left behind. Those are the people who are voting, who are supporting those strongmen that I was referring to. And given that automation, given that I think hopefully free trade and a recalibrated globalization will still be with us, I think we need to work extra hard to prevent the world from going in that direction. But I think leadership more broadly. So what does it mean to lead a team when you're doing that remotely? What does it mean to lead a team when you have a different ratio of robots to workers or automated processes to human-mediated processes in companies? I think leadership at all levels, from the political leadership of a country all the way down to the leadership of teams in organizations, I think there's going to be quite a bit of rethinking and reconsideration of some of the principles that we felt, were kind of the gold standard in terms of leadership.
Thank you. And we're just at the top of the hour. We have one last question coming in. Besides changes in the content, reorganization, and transformation, do you see also changes in the format, how managers and leaders should be trained?
Oh, absolutely. Absolutely. And I think this will have, by the way, enormous implications for our MBA programs and for our undergraduate programs in business. So I think especially so for the degree students, because they are preparing themselves to become leaders, right? So I think we will have, as business schools, a very important role to play there. But I also hope that at the level of executive education, there's a big role for us to play in terms of helping people who have, in some cases, decades of leadership experience adapt to the new situation. So again, I mean, I strongly believe that leadership and organizational behavior are going to be extremely important in the next few months and years as companies, organizations of all types transform themselves, right? It's going to be, let me put it that way, a goldmine for the professors who do research in that area, for the program managers, many of you who are, offering executive education courses on leadership and organizational behavior, talent management, all of these areas. Because once again, I think some of the basic parameters that we were working with in the world of organizations have changed as a result of this crisis. And it's still too early to know how many of these changes will be permanent, but it seems to me that at the very least, we're going to see an accelerated trend in the directions that we've been discussing during this webinar. So I think it's just going to be a golden opportunity if we are quick enough to also transform ourselves and realize that we need to offer different content. You see, I haven't mentioned that word, content. I have been making a very big effort over the last few weeks to promote more content. And if you would allow me, Rob, I just wanted to show, because I know it's the last question, that if people would like to get materials, all of them for free, by the way, there's nothing to be charged here. They can go to my website. There's videos, there's free sources of information, there's presentations on some of the consequences of the crisis. I think you will find this resource here quite useful.
Well, thank you for pointing that out, and I'm sure many of our participants today will visit that and take advantage of those resources. And let me thank you, Mauro, for a wonderful presentation today, very helpful, very insightful, and also for taking the time to thoughtfully answer the questions that came from the audience. Just a reminder to the participants, today's webinar has been recorded. You'll receive a link to the recording via email in the next few days. And please don't forget to mark your calendars for the upcoming webinars that we're hosting, again on June 3rd at 10 a.m. Eastern Time, Emerging from the Crisis, Talent Development in a New Normal. And then again on June 10th at 9 a.m. Eastern Time, Voice of the Customer during COVID-19. Mauro, any final thoughts before we wrap up again today?
Well, I think first of all, stay healthy. Second of all, I would say be creative, be innovative. I think every crisis is an opportunity, but it's an opportunity only to the extent that we start abandoning the old ways of thinking. So we need to, creativity and innovation, I think, will be very important. I fully realize that your job has been made much, much more difficult as a result of this crisis. because there's been a lot of cancellations. And of course, at least in the short run, demand is down, and we have to learn a new technology and everything. But be confident that if we innovate, if we are creative, I think we are in a good position to help companies adapt to this new situation.
Great. Always good to finish on a positive note. Thank you again, Mauro. Thank you, everybody, for joining us. That concludes today's webinar. We'll see you again soon.